Bank of America, here with us in the Swiss Alps. Brian?
I think, number one, we come to learn, because if you think about the range of topics that are talked about, the range of information you can gather from all the different participants, you come to learn. And as CEOs, we always have to learn. Learn about what's going on in a particular country, what's going on in a particular industry. It's important. The other thing, and uniquely for banking, it's a chance for all the CEOs of all the institutions across the world to actually sit together in a room and with policymakers and others and have a dialogue. And I think that dialogue has changed over the last 4 or 5 years I've been coming, but that's very important. And the third is obviously the clients and seeing our clients and seeing what's interesting to them. And it's a chance to convene and see a lot of people in a relatively short period. That's the dichotomy of why we're here. I'd say that we're looking at, we had a recovery in the banking industry, but we have a societal obligation to drive. And so in the United States, where we engage in everything we do, our small business lending is up 20%, 25% year over year. Our mortgage lending was up until the refis drained off, but the purchase business is strong. Our credit cards are up. So we're trying to participate in the economy, but the economy has to grow through its fundamental ways, and the banks are there to help it. And so I think you have both those issues. The industries are covered, the capital levels, liquidity, still have work to do. All of fundamental economies here, and how we help growth and how we support both idea exchange and other information.
Brian,
we have, in our company, we have really focused on trying to do everything correctly, the right way, for the right reasons. And so we started on a journey that you and I have talked about many times 4 or 5 years ago to start to simplify the company. And I think if you sit down and say, what's the purpose of a financial institution? That's to help our clients and our customers live their lives. We have done everything we can to narrow the framework of the business. And I think as we continue the compliance and risk, and that's because if you look on a lot of different cases and stuff, because we were the biggest, because of the Countrywide acquisition, we were deep into this earlier on. And so, for example, with Fannie Mae and Freddie Mac, we settled through with them. With a lot of pieces we've done, there's still uncertainties. We have investigations by the Department of Justice that we've talked about to people, and we will deal with those as they come up. But the reality is that what we were able to and really had to get to over the last few years to start to clean the balance sheet up and take the uncertainty around the company away, starting in 10 and 11, we did a lot of work, and it cost us a lot of money. And so some of the numbers people talk about, a lot of it's been spent. Yet we still, I think, Eric, you asked me that question a couple of years ago. I don't use the analogies. You look at the fundamental cases and what we've settled and closed off, and look at the various pieces of liability. We've done a lot of work, but it's cost a lot of money.
Yes,
and now,
it has.
But we built really the best capital ratios in the U.S. industry. We've built, our tangible common equity ratios is over 7% now last quarter. And so we rebuilt the capital liquidity, but hard to get people focused on, but they can start to see is the underlying business have been market share investment banking, whether it's our market share in cards, whether it's our consumer market share, we've been driving that. And now as the cloud lifts, and a couple of years ago we talked about a backpack and going up with a backpack and carrying all that weight. As that comes out of the backpack and the weight gets lighter, we should sprint ahead. Well, you always say both, probably, in that but the analogies or the similarities between companies have to be sorted out literally case by case. This is Gary Lynch and the team have been working this, and unfortunately, as I said before, we have a lot of experience in this, and so you have to really take them apart case by case, brick by brick, and we still have the work to do. But if you look at some of the fundamental putback risks that you have 2 years ago, you've talked a lot about that, the rep and warranty risk. Largely we settled out substantial parts of that now. Look at our market position, our talent, and our capabilities. We can bridge from how we have very different businesses, and they have very different compensation schemes, and always have had that. And we've always owned these businesses, nothing new to us. And so whether it's financial advisors or whether it's investment bankers, and so I think if you look at the track record, we have retained the talent we needed to drive the growth, and Tom Montag on one side of the house doing it's what we get paid to do.
Look, but your bank still trades at
I think if you look in 2012, we had a 100% plus return. 2013, 35% or whatever it was, at 9% plus year to date. And this is on a big market cap, so these are large amounts of movement. But I think in the end of the day, as the street looks out and people estimate, it's really getting to that normal earnings capacity. So last year we earned $11 billion. We need to earn back to the normalized earnings level that we've talked about. And as each year as we put more things behind us, we went from $2 billion to $4 billion to $11 billion, you will see that discount come down. A lot of it's come out, but you'll see it come out as we make it's everywhere. And we're growing. If you look at the revenue growth, in a business like mass market consumer, because the interest rate environment, in our general retail business, that's tougher. But if you look at what we've done there is we managed the expense base carefully. If you look in our investment banking fees, those grew nicely year over year. And the last quarter was one of the record high levels. If you look at our wealth management space, it's at record revenues, record profit margins. So, we look across all the businesses, and there's always ebbs and flows. If you look at the trading business, it's been a little more muted in terms of gross revenue. Now, as we come into the first quarter, it's a stronger quarter. But if you look at the consumer businesses, they've been moved the money, and that's an opportunity. But we saw a pretty substantial move in rates, and some of the experts you'll have talk over next week will talk about that, to go from 150, 160 basis points 10-year Treasury to 280 to 300. It's a doubling of rates, really, since late last summer. So, the people are anticipating what the Fed's going to do and moving ahead of it, moving in ebb and flow based on the economic news. But I think, our job is our job is to be in the middle and help people find liquidity and move money around. And if you look fourth quarter, I think we made money quarter after quarter. That's been true. It's because it's a client business. It's not a big. We got our proprietary trading. So our risk is, do the clients shut down activity, and that's what you see in the flows, as opposed